Good morning, candidates. Monetary Policy Terminologies. Monetary Policy Committee. The Reserve Bank of India Act 1934 was amended on September 19, 2016 by the Finance Act 2016 to provide for a statutory and institutionalized framework for a monetary policy committee for maintaining price stability while keeping in mind the objectives of growth. The mandate given to RBI is to ensure the medium-term target for consumer price index inflation of 4% within a band of plus or minus 2% while supporting growth. The Monetary Policy Committee has been entrusted with the task of fixing the benchmark policy rate, repo rate, required to contain inflation within the specified target level. A committee-based approach for determining the monetary policy adds a lot of value and transparency to monetary policy decisions. The meetings of the Monetary Policy Committee are held at least 6 times a year, specifically at least once bi-monthly. As per the provisions of RBI Act, out of the 6 members of MPC, 3 members are from RBI and 3 members of MPC are appointed by central government. Liquidity Adjustment Facility. As part of the financial sector reforms, in 1998, the Committee on Banking Sector Reforms, Narasimhan Committee 2, LAF, was introduced, under which the Reserve Bank would conduct auctions periodically, if not necessary, daily. LAF is used to aid banks in adjusting the day-to-day mismatches in liquidity. LAF helps banks to quickly borrow money in case of any emergency or for adjusting in their SLR, CRR requirements. LAF consists of repo and reverse repo operations. Repurchase agreement or repo. Repo is a money market instrument combining elements of 2 different types of transactions, namely lending or borrowing and sale and purchase. A repo or repurchase option is a collateral lending. That is, banks borrow money from RBI to meet short-term needs by selling securities to RBI with an agreement to repurchase the same at predetermined rate and date. The rate charged by RBI for this transaction is called the repo rate. The collateral used for repo and reverse repo operations are Government of India securities. Under repo, the RBI injects funds to organizations, that is scheduled commercial banks and primary dealers, which have both current account and SGL account with the RBI. The repo transaction has 2 legs. In the first leg, the seller sells securities and receives cash, while the purchaser buys securities and parts with cash. In the second leg, the securities are repurchased by the original holder by paying to the counterparty the amount originally received by him plus the return on the money for the number of days for which the money was used by him, which is mutually agreed. Thank you. I will give next 3 points in another video. Thank you.